Let me know when we're live here. Good evening and welcome to this live Ask Me Anything About Property Investing with myself, Saj Hussain. I'm here every Monday evening at 8:30 p.m. to answer your property investing questions. So whatever questions you've got for me on whichever platform you're watching on, whether it's Facebook, YouTube, LinkedIn, Twitter, Instagram even, make sure you pop a question in the comment section below. My assistant's over here, Khalid, he'll fire the questions up on the screen and we'll answer them in the order that they appear. Don't wait till the very last minute like some people do. Some people wait till the very last minute before they start asking a question and we don't get around to it. So if you've got a question you want answered, then make sure you put it in nice and early. So do I know everything there is to know about property? No, absolutely not. But I've got a huge amount of experience. I've been investing in property for about 15 years now, and I've done many different strategies. I'm more than happy to share my knowledge and experience with you to ultimately help you get further faster in your property investing journey. I also spend time on my YouTube channel, which is 3 videos a week, again, to help you with your property knowledge, sharing with you what I'm up to, the kind of projects I'm doing as well. So we used to run a property meet. I say we used to run one. The last meeting that we had was in February before lockdown happened, and we've not been able to run those events again. So hopefully sometime in 2021, we'll restart those events. But in the meantime, the YouTube channel is where I'm putting my effort in to get regular content out to you. And then these sessions on a Monday evening. So let's get started with our first question on the screen over here. I'll read the question and then we'll, as I said, make sure you put your question in the comment section. So first one is on YouTube. My apologies in advance. I'm not even going to attempt to try and pronounce that name because I'll only embarrass myself. If we purchase a property with a mortgage or a bridging loan, they allow us to demolish a house and build 2 houses in the land? What are the things that we need to take care of in such projects? So a great question. So if you're purchasing a property with the intention of demolishing it to build something else there, then it's really important the lender understands what you're doing there. So for example, let's say it's £100,000 that they lend you to buy that particular site. Once you purchase the property and you knock it down, it's probably going to be worth less than £100,000, particularly with nothing on it there. And as you start building back up, the value will slowly start increasing and you'll get to a point where it's back to 100, then much higher, because now you'll have 2 properties on that site. So the lender needs to understand that's what you're doing so that they lend you the money in the right way. Otherwise, if you just knock the building down, what effectively you've done, you've destroyed their security, what they've got their money secured against, and that can get you into a lot of hot water and into some bother. So it's important that your lender understands your intentions and what you're looking to do with it so that the finance can be structured in the appropriate way. So there's no issue with doing that. It's just that the lender needs to understand what you're doing so it's done, as I said, in the correct way. So hopefully that helps you with that. Let's see our next question. Our next question is also on YouTube. Anetta, do you require a deposit for a bridging loan? Yes, so when you're purchasing a property with bridging, bridging essentially, it just bridges a gap between 2 things. So you start off with a purchase, for example, and you've got an exit agreed, and the gap between those 2, that's what the bridge is doing. So it's like a temporary loan. It's a short-term loan, often for up to a year. So for instance, it might be you purchased a property, let's say at auction, and you've got a bridging loan in place, so you add some value to it, you renovate it, and then you remortgage it onto a normal, say, buy-to-let mortgage. You might do that in 6 or 8 months' time, and then you repay the bridge. So the bridge was just a method for you to be able to acquire the property whilst you're doing some work on it and get a normal long-term mortgage put onto it. So with bridging, is it possible to purchase without putting any money down at all? It is, but there's only a few bridges that will be open to such type of projects. And essentially what that means, you're not putting any money into the deal. So if you're doing a project like that, really what they want to see is that they've got plenty of equity in that deal. So if, God forbid, they get to a situation where they have to repossess that property and dispose of it, they want to know that they can comfortably exit out of it to be able to repay the bridge, any interest and costs that have incurred, so that they don't lose money. That's the important thing. So these days with the market, the way it is, pretty strong, pretty buoyant, it's not very easy to find properties with massive discount, massive below market value properties. But if you were able to, there are probably some bridges that will lend you the 100% of the money that you need. But generally speaking, it tends to be around 75%. So they'll lend you 75% of the purchase price, not necessarily the value, and then you put in the other 25% in. But also be mindful, often bridging, the way it's structured, they'll look at the interest for the period that you want to borrow the money for, and they'll deduct that from the money that you need. So for example, let's say it's a £100,000 purchase. you're putting £25,000 down, they're giving you £75,000. But what they'll do, they'll deduct their interest. Let's say the interest was £10,000, just for sake of simplicity. That means they're actually only giving you £65,000, even though the loan is £75,000. So you need a little bit more to cover that as well. So it's important to understand. And again, you just need to speak to a good mortgage broker, a finance broker that can help you to find the right product for what it is you're trying to do. So let's have a look at our next question then, which we'll have on the screen in a moment. So this is from Sunil on YouTube. What are the areas in the HMO that need emergency lighting installation? So emergency lighting is essentially, you see in commercial buildings where you see a little green light, and sometimes a picture of a running man over a light, maybe over a door, for instance. And what that's supposed to do, in the event of a fire, it lights up to show you the way out of the property. So there isn't a specific number that you need 3 here and 2 there. What you have to do is take a logical approach and say, okay, well, if it's pitch dark in here, if there's a fire, the lights went off and it was smoky, then this sign lights up. They need to be able to find their way out. So you need to plan through a route, and normally the electrician or whoever's installing this would do this, particularly if they're experienced. They'd work out how many lights that you need and where you need those, so that they can serve their purpose and light up and guide somebody out of the property in a case that there is a fire. So they serve their purpose. So I hope that helps you with that there, Sunil. So let's get our next question up on the screen, which again we'll have in a moment. So next one's on YouTube, which is Aisha. Article 4 citywide 4-bedroom house. HMO inspector has said doesn't need HMO license but needs planning. Is it worth putting application when the council will deny it, or better do service accommodation strategy instead? So interesting point. If you've got, so Birmingham, for example, as we have Article 4, and what that essentially means is that we can't create a HMO without going through planning permission. As soon as we've got more than 2 people sharing in a property, it's essentially a HMO, and we need planning permission to do that. In non-Article 4 areas, or what Birmingham used to be previously, most of the city, what that meant was we could take a regular family house and we could convert that into a 6-person HMO, so up to 6 people living there without the need for planning permission. And if we went beyond that, say 7, 8 or more, then we need planning permission for that. But now if you've got 3 or more people, you need planning permission. This is very separate to licensing. And if you want to know more about this in detail, make sure you find my YouTube video on the channel where I talk about licensing and planning, just to be clear in terms of the context of HMOs. Now, the HMO licensing officer is correct in the sense that you don't need a license because it's only 4 people, because the licensing starts from 5 people. However, planning is required. Now, if you think about why they've introduced Article 4 in Birmingham, it's really to control the number of HMOs, where they exist, how many there's already there, how close they might be to existing ones. So all of these things, that they have concerns around this, and they want to control what appears where. That's the purpose really of introducing Article 4. Now, if you're going to look to create a HMO where there's lots of existing HMOs, let's say you pick Erdington, for example, lots and lots of HMOs in Erdington, and if you pick a street where there's already many there and you want to put another one there, and let's say you've got HMOs on one side, HMOs, you've got a family house and some more HMOs, and you're going to put another HMO there, so really there's only maybe the odd one family house. Those kind of things is what they really don't want to see. They don't want to see lots and lots of HMOs together. They want to start seeing them spread out. Whereas if you find another part of the city which is much quieter in the sense from a HMO point of view, where there's not many there, you probably find it'd be easier to get planning. So it's not a case of you can't get planning. There's no automatic refusal. It's just understanding what it is that they're looking for and being able to comply with those needs. And then you should be okay in terms of getting the approval in place. But whereas if you go to what I call the very busy areas where there's already lots of them there, then you might struggle. But the other thing to bear in mind is who your tenant type is going to be. Who is it that's going to be living in that property? So for instance, if you say looking at say professional tenants, working professionals, then there's parts of the city, I'm just using Birmingham as an example now, which are established areas where people generally gravitate towards where there's already lots and lots of these types of property. So it's like having a shop on a busy high street. There's already a flow of people there that will be your customers. In the same way, if you have a HMO in a kind of very busy location where there's lots of HMOs already, there's established demand, you'll find it's probably easier. Whereas if you go off to a brand new area where there's no HMOs at all at the moment, and it may be a reason for that, it might be there's no HMOs there because there's very little demand for them, or it may be that no one's actually decided to do any there before. So this is where you're taking a little bit of a risk. You need to make sure you do your research to ensure the type of tenant that you want to put in that property is going to be wanting to be your tenant in that location before you make an application to convert it into a HMO. So I hope that helps. So let's jump on to our next question. So if you're watching over here on Instagram, thank you so much for watching. We've got a couple of cameras set up here. As I said, we're live on various different platforms, on Facebook, YouTube, LinkedIn, Twitter, Instagram. If you've got a question, make sure you put it in the comment section. I'm here every Monday at 8:30 p.m. really to answer your property investing questions. So I try and do these as quick fire, answer as many as I possibly can to help you. I know I do lots of content on my YouTube channel. If you want a lot more help, if you want much more hand holding and helping you through the process, and then reach out, I have some mentoring as well that I do that we can talk about whether that might be right for you as well. Just send me a message on whatever platform you're watching on, and then we look to see if we can help you with some more personalized and hand holding if that's what you need. So let's get our next question back up on the screen, please, Khalid. And that is from Madassa on LinkedIn. Can I do joint venture with you? So great question. Yes, you can joint venture with me, but what I look for in a joint venture partner, really the way I see my partners is they're funding partners. What that means is they're funding the deals. I use my time, skill, experience. I find the fantastic property investment opportunities. Then I partner with people who have the cash to fund those projects. And there's two ways I do that. One is they either lend money for projects, which is really a fixed amount of money for a fixed period of time for a fixed return. For example, might be £100,000 over a year at a fixed rate, depending on what project it is. That tends to be a minimum of £50,000. If you want to work with me as a joint venture partner where we're sharing the risk and the reward, it tends to be bigger projects and it needs to be a minimum of £350,000. Generally, that tends to be more high net worth individuals that tends to be suitable for. And if you're interested in any of these things, again, ping me a message and then we can have a chat about what kind of projects I might have that might be right for you, where you can get involved in investing with me. That might not be right for everybody, but that's the criteria that I have in terms of working with me. So thank you for that question there. Well, that's also gave me a great opportunity to plug what I do. So this question is from Amjad on Facebook. Auction, how early should you arrange finances, a residential commercial mortgage or bridging loan before anticipated auction date? Unclear if bridging loans are general or house specific. So there's a couple of different approaches here. These type of loans that we're talking about are property specific. So what that means is they're lending money on that particular property, the purchase that you're making, depending on the price, depending on the value, it'll be structured accordingly. Yeah, depending on what you're doing with that. Now, if you're going to an auction and you've got 5 lots you're looking at, well, actually you can't have 5 bridging loans already pre-arranged to do that. However, what you can do is do the initial stages of making sure you're getting pre-approved for a loan. Because remember, when you're applying for any kind of finance, and I've got another video on buy-to-let mortgages, which talks about this in a little bit more detail, which is a little bit similar, but you've got to think about the different stages that are considered when you're borrowing money from these types of lenders, whether it's a bank, a bridger, or a traditional mortgage. So there'll be you that they'll be looking at as an individual. They'll be looking at the property as well, and also what you're doing with it in terms of who's going to be living at the end. When you're bridging, generally it's more short term, so they're not really thinking about the tenants. For the longer term, they're really thinking about in the short term you and the property as well. So the you bit is what you can get done beforehand. You can make sure you've been pre-approved. They're happy with you as an individual. They've looked through your accounts, they've done the credit checks and all that stuff they're happy with. And then that way, once you've found the property, it's just really getting the application rolling with that particular purchase. And that will save you a little bit of time. But generally speaking, bridges tend to move quite quickly, especially those that specialize in auction type of property, because they know you've only got a few weeks to get this wrapped up and they'll generally move fairly quickly. But if you wanted to be sure you get that all lined up, I'd speak to a broker beforehand. The broker would find a suitable bridging lender for you and one that you can get kind of pre-approved and ready. Then it's just a case of making the application for that specific property. So I hope that helps you with that. So our next question is Synex. on YouTube. Thanks for all your efforts, Saj. Can I ask if you generally give washing machine and tumble dryers in a HMO? If yes, how many for six bed HMO, and where do you keep them? So we tend to put in a combined washer dryer where we can. Occasionally we'll split them into a washing machine and a tumble dryer, but in short, yes, we provide both. And I know many HMO landlords don't like the idea of providing tumble dryers. And the reason for that is because of the cost of running them. They run off electric, so they're just using quite a lot of power. But the reality is, if you think about it, if you're not giving somewhere for your tenants to be able to dry their clothes, what they're going to do, they're going to stick them on the radiator, and they're going to put them on drying lines inside the house. And what's going to happen is the clothes are going to become dry because all the moisture is removed from the clothes, but then it goes into the atmosphere, into the space within the property, and all that moisture is going to be going into the property fabric and starting causing condensation problems. So to avoid the condensation problems in the first place, you need to provide some kind of method where they can dry their clothes, because people need to dry their clothes. If you don't provide the facility, then it will just use the radiators to try and dry their clothes. So, you know, sometimes you walk into a HMO and you can see lots of clothes just left out being dried, and although the clothes will become dry, as I said, but they're damaging your property ultimately. So that's why we provide tumble dryers. We don't really find that they get abused, that they're running all the time, they're burning up lots of electric in terms of operating them. So we certainly don't worry about that, and we don't use any kind of coin operated or charging for use of a washing machine and tumble dryers. I know some people do that, but I guess it depends on the type of tenant that you have. In terms of how many that we have, so up to 6, we'll only have the one. So the one washer dryer if there's 6 people, which is most of our HMOs. Because the way we also look at it is really that can be one day a week. For example, Monday to Saturday, room 1, room 2, room 3, or we're going up to room 6. So they could have a dedicated day to do their washing, drying. And then you've got Sunday, which is where the machine's not used or anybody could use it. So really we find it's more than enough. You don't need more than that. Now, it doesn't mean that room 1 can only use the washing machine on a Monday, but you know, sometimes you have issues where tenants don't get on and there's issues. And then if you have to kind of lay the law down a little bit, then you can specify and say, hey, you can use on Monday, Tuesday, Wednesday, etc., etc., etc. And so we don't find really that we ever have any issues with that. So yes, in short, we have a washer, a dryer, combined unit, and for up to 6 people, it tends just to be the one unit. And if there's any issues in terms of repairs, we get it dealt with straight away. We don't delay because you know, you don't want a position where people have got washing and drying kind of building up where they can't use the machine and getting upset as well. So let's get our next question on the screen. This is from Coop on YouTube. Hi Saj, how do you execute an exchange with delayed completion? What are the steps? I've found a commercial unit with the potential to add flats above. I don't have the cash for the refurb yet. So a few things that you need to consider. It's a commercial property. Okay, so there's a few things that you need to consider here. If you're looking to do the purchase, first of all, you need to be sure that the seller is in agreement with what you're trying to achieve. Assuming you've sorted that out, that they are quite okay with committing to the transaction, but you're not actually completing it just yet. And there might be many reasons why they might do that, but there'll also be many reasons why they choose not to do that as well. So this is what you need to think about. So just to add a little bit more meat to the bones there for you, let's say a property's just come onto the market and it's £100,000, just because it's an easy number to work with. Let's say it's £100,000 and you go in and say, yes, I'm interested in that property. I'll pay you £100,000, but it'll be in 6 months' time. In the meantime, exchange contracts with me. And the agent or the seller might be thinking, well, why do we want to do that? Because we've only just got on the market. There's 6 other people interested right now. Let's see what happens. So they may not be interested in doing that. So one thing you could do is potentially offer a little bit more to incentivize them to go with you rather than somebody else. Or alternatively, if the property's been on the market for a little while and it hasn't sold, then of course, you know, there might be more opening to listening to your proposal because they may be struggling to sell right now. So this is how you can kind of create the circumstances. Now, an exchange with delayed completion is much more common than, for example, a lease option or option contracts or purchase lease options, which tend to be much more specialist. Many solicitors in the commercial world are quite familiar with an exchange with delayed completion, or sometimes called long stops. And what you're effectively doing is you're going through a normal conveyancing process as you would ordinarily. You get to the point where you legally commit, where you have to purchase and the seller has to sell, and that's your exchange of contracts. And then normally it might be a few days or a week before you then go to completion. However, in this case, what you're doing is you're stretching that out. You're making it a much longer period, a month, 2 months, 6 months, a year, whatever it might be. It could be much, much longer than that as well. So there's different ways to structure the deal. But effectively, what you're doing is you're locking the seller in so they can't go anywhere else. And it gives you the opportunity to do, for example, planning gain. You won't need to go and get planning. But what you have to think about is, what if you don't get planning, or what if you don't get it in the time frame that you need? What you're going to do at that particular point, because you're committed to the purchase if you exchange contracts. One of the things that you can do is do a conditional exchange of contracts. And what that means is that you're exchanging contracts in the normal way, and the solicitor will be familiar with the process. However, you're putting a condition in that contract that if certain things aren't met, it will allow you to come out of that transaction. So for instance, if you're applying for planning to convert it to, say, 4 residential units, and that planning approval doesn't come through, it allows you to come out of the transaction so you don't have to complete on it. However, again, you have to think about, why would the seller enter a transaction like that with you? There has to be something in it for them. So for example, it might be you put £5,000, £10,000 down up front, which is non-refundable. So now, if you back out the transaction, the seller is still going to be somewhat financially better off than if you just walked away without committing anything. So you need to try and find a win-win. And these are just examples I'm giving. There's many, many different ways to structure a deal. But here I'm just giving you some examples to think about how you can create something that works for the seller and works for you as well as the buyer. So it's not just about you, it's about getting it work for the seller as well. So I hope that helps with that. Let's get our next question on the screen. So next one's from Ruhel on LinkedIn. How much is a good amount to start with in property industry, and would you consider equity release to fund? So let's do the latter part of that first, equity release. So generally we're talking about equity release. If you already have property, you're borrowing against that existing property, you're releasing equity from it. So for instance, let's say you've got a £200,000 house and you've got a £100,000 mortgage on it. You can borrow up to 75%, say, which means you can draw down another £50,000. So taking the total borrowing to 150,000, that might be a remortgage with a different lender. That means you're borrowing 150. The 100 is used to repay the first lender, and you're left with £50,000. Whichever method you use, effectively what you're doing is you're drawing down, you're borrowing £50,000 of the equity that you have in that particular property. So of course, this is one method, and a method that's very common and very popular for people to be able to purchase more property is using the existing property to borrow money against. And so but remember, the more you're doing that, the more you're leveraging up. So you have to think about where you're comfortable in terms of leverage. So generally speaking, the banks will want you to be leveraged no more than 75%. That means there's about 25% equity across the portfolio. So if we roll the clock back to kind of the pre-credit crunch, 2006, 7, at that sort of time, it was possible to get 100% mortgages, 95% mortgages, 90% mortgages are very common. These days, 75% tends to be the line where most borrowing is done. So if you're increasing your borrowing to 75%, remember you're kind of increasing your gearing across your portfolio. So you can draw equity down, and that's a great way to start. In terms of how much you need, well, really, this is a little bit like asking how long is a piece of string. It really depends on, what type of strategy you're looking to implement, what is it you're trying to achieve ultimately, where you're based in the country, what type of buildings that you're looking at, whether you're focusing on cash flow, whether you're going to be flipping property for capital. So it really does depend. And sometimes people talk about buying property with no money or no money down, and you might have heard me talk about that as well. But ultimately, if you're purchasing a property, let's say it's £100,000 property, and it's no money down. No money down means none of your money, but somebody's money is going to come in to do that transaction. So unless it's a creative one, like, for example, delayed completion, we were just talking about a moment ago, where you don't actually take ownership, you're taking control of the property, but not necessarily ownership. So here it's about thinking about, can you use other people's money? Can you leverage other forms of assets to bring more money in to be able to get started what you're doing? So I would think about, what is it you want to do in property? What goals you're trying to achieve? What might be the right strategy? And then think about how much capital you might need for that type of strategy and type of investing. And remember, if you've got money around you and you're starting property, it'll certainly be much easier. And if you're starting with no money whatsoever, which is really where my journey started 15 years ago, it's much, much more difficult, but not impossible. So let's get our next question on the screen. So this is from Mr. H on YouTube. Hi Saj, regarding development, what is the rule of thumb applies price per square foot when building flats? Again, this will vary throughout the country, and there's a number of things that you need to take into consideration. But when I'm costing things, you know, I might be looking about £120 per square foot, going to maybe 140, depending on basic ones. If they may be higher spec, it might be 160, but even £180 a square foot wouldn't be unusual. It really does depend on what you're building. So what I'd look at is maybe getting a QS, a quantity surveyor, on board to help you with some of the costings if you're looking at a project, and you might be putting it out to tender for the builders to quote on that particular project. But if I'm doing my costings, you know, a lot of the stuff that I look at, I'm looking at about 120, 140 pound a square foot to build that. In the past, I've done stuff for less, but I'd say that's much more difficult to do. So that's probably the guideline that I would use. And I would say that's not set in stone, but just a guideline. Our next question is on YouTube from Saeed. And that's new to JV new builds, how to attract new build JV investors. So if you're brand new to property and you're just starting out, essentially what you want to do, you want to attract investment for people to come and invest with you, then really what you have to think about is how can you become investable? And what that means is why would somebody invest with you? What is it that you can bring? What value are you going to bring to somebody to invest? So for example, it might be you say, well, I found this amazing site, we can build it out, we've got this X profit. Hey, that's brilliant. But actually, do you have the experience, the track record, the connections, the understanding, the knowledge to be able to deliver a project like that? Because talking about it on paper is very different from actually delivering the project and producing the results. So if you've got some experience, that always makes it much easier. But if you're brand new, as you said you are, you're just starting out, if you're absolutely brand new to property, maybe building brand new houses is not where I would start. But if that's where you want to be, then one of the key things I would do is I'd look for people that are more experienced to work with you. So as I said, I've been in property many years now, but when I started my first new build project, it was still brand new to me at that point. This is something I hadn't done before. So the way I de-risked the project was firstly had a partner on board who was experienced in terms of building houses. So although we weren't going to actually physically build them ourselves, he'd done similar projects before. He was doing one for himself. He'd done many others as an employee with other companies. But this is a project that we started together. But also what we did have, we had what we call an employer's agent, which is essentially a quantity surveyor that works with us, that helps manage the project and manage the numbers to make sure what we're paying for is the work that's being done. So this is de-risking it. But of course, this also adds layers of cost onto your project as well. So you've got to have significant profit in the deal so that you can actually do a deal in that way. So my first new build that I was looking for, it took me a little while, probably well over a year before I found the right deal to actually start as a new build project. Because it had sufficient profit in it, I knew if I was going to make mistakes and learn along the way, and there's going to be some challenges that we face, which ultimately we did, that means there's enough profit in there. That means it's going to be something we can absorb. If the profit was wafer thin and then we hit some challenges, then you really wiped out your profit right from the beginning. So really, for me, it was about de-risking it with finding a meaty project, have people within the team and around me that have got much more experience, which means the success of that project is much more likely. So we'll take one more question in a moment. If you're enjoying this content, just let me know your thoughts. I'm here every Monday on at 8:30 p.m. as I said, for about half an hour to answer your property investing questions. We're live on various different platforms: Facebook, LinkedIn, YouTube, Instagram. Here to share my knowledge and experience with you. Make sure you subscribe to the YouTube channel Saj Hussain, where I've got 3 videos a week that I'm sharing my knowledge and experience with you as well. So let's get this question on the screen. This is a prank inception on YouTube. Hi Saj, I'm 24 years old and have saved around 50,000. I really want to get into property and I'm currently educating myself. The one problem I foresee is that I live in London. Is it still viable? So there's more to the question. If so, how do I get around this? As I know areas like Nottingham, Birmingham, etc. are really good places to invest, but traveling every day to work on the property doesn't sound viable. So some really good points there. So first of all, London is, what I would consider a micro market. Well, it's not micro, it's not small, but it's a different market. It's a market within a market. So what we mean by that, but generally we might have property investing strategies around the country, but London, what happens in London is very different. Often people invest in London for long-term capital growth. So the prices are constantly rising. It's a capital. It's it's a major city around the world. So what happens is the prices are constantly rising, as I'm sure we all know, and we've experienced as well. And which means that your returns and your yields become very, very low. And some people choose to actually sell up in London and start investing elsewhere so they can get a better return. And other people just want to invest in London because they feel safer there and they're happy with earning very little right now, with the view of getting a long-term capital growth. That means that's how they're going to make their money out of that particular type of investment. So the alternative is to invest elsewhere in the country, somewhere else. Now, you have to think about what's comfortable for you distance-wise. When I first started, I initially was looking about 45 minutes distance from where I live in Birmingham. If I could drive there within about 45 minutes, I was quite okay with that. And even in the early days, I was working with other people's money. So I was very conscious of being in control of what's going on, because I wanted to make sure that I deliver the project successfully. We don't lose any money. So I was very obsessive about being there and being on site. Now, of course, as I got more experience with that, it means I had good people, good teams around me. My radius started to shrink. So in terms of I was much closer to home in terms of where we do deals rather than having to travel so far out. So it's really about finding the right people on the ground that can help you. If you pick a big city, for example, Birmingham, Nottingham, these places, you'll probably find lots of people there that you could potentially work with. If you pick a small town, let's say you can do HMOs in some small town, there might only be one HMO agent in that town. And let's say, for some reason, God forbid, that relationship breaks down, then now you're stuck because they were the only person that you had. You don't really have anybody else to turn to. So I think a bigger city, you're de-risking it by having more people around you that you can work with. But ultimately is having local people, knowledge on the ground, people that are on the ground, understand this part of the street is very different from that part of the street. Now, you may not build that knowledge initially, but you do need to make an effort to understand the dynamics of that particular town or city, what makes it work, what type of areas work better, what type of property works better for which type of deals, what longer term is likely to happen in that area, and where you see things will go from there. So, first of all, I'll say well done for saving a pot of cash to get started. I think in London, you're probably very, very limited in terms of what you could do with that small pot of cash. Probably for investing further afield, it's probably going to be easier to get started. And of course, as I was saying earlier on, it does depend on what your outcome, what your objectives are. What is it you're trying to achieve, whether you're building cash flow or capital, to find the right strategy. And of course, the further north you go, the cheaper the properties become, but they're cheaper for a reason as well. So look, I hope you've enjoyed this content. As I said, I'm here every Monday evening. If you haven't got your question answered, make sure you're here early next Monday. Get your question in nice and early so we can get that answered. And I just want to say thank you again so much for watching. I look forward to seeing you again next Monday. Thank you. If you're watching on Instagram, thank you so much for watching as well. I hope you've enjoyed this content. Remember, I'm here every Monday evening answering your property questions, and I look forward to seeing you again here next Monday evening.